Hello and welcome to this Cornerstone Finance Group podcast brought to you by Business News Wales and produced in collaboration with Scottish Widows. I'm Gemma Casey, editor of Business News Wales, and in this episode we're going to be looking at personal protection insurance. Life cover, critical illness and income protection can provide long-term security for clients and peace of mind for advisors. So how do mortgage advisors go about ensuring they're prepared to offer tailored advice? Well, with me to discuss this are Rob Jackson, Mortgage and Protection Advisor at Trust Mortgage, Steve Evans, Business Development Manager at Scottish Widows Protection, and Phil Emanuel, Director of Growth at the Cornerstone Network. Hi all, thank you for joining me.
Morning.
Hi, Joe.
So, Phil, let's start off then by looking at the importance of having the right protection in place. So we're not just talking about mortgage cover, are we? We're talking about how a mortgage advisor supports the overall financial well-being of their clients.
Yeah, that's right. Protecting, whether it's the mortgage or the family, it's a vast area of business which perhaps over the recent years has been underused. And I think we all know that there's a massive sort of protection shortfall in the UK, which I think we've been trying to address for years. But Consumer Duty seems to have given this a bit of a shot in the arm recently. So we have seen an uptake in protection sales. But I think it's vitally important that advisors get used to talking to their clients on a more generic basis. You know, the mortgage is just part of protecting the family and everything that's going on in this. And what we're looking for really is for advisors to become good fact finders or information gatherers. And I think that's the first step really along the route, to have all the information, making sure the customer is feeling comfortable in those conversations.
Thank you, Phil. And Steve, if I can come to you, tell us a little bit about the types of insurance that should be considered and what does Scottish Widows offer?
I think I'd just probably dovetail off what Phil said there. So it's vitally important we have broader conversations with clients about what's important to them. Because clearly, a mortgage debt is important, but it may not be the only thing that's important in their lives. If you take, for example, first-time buyers, roughly about 40% of their salary goes on a mortgage, and therefore 60% goes on other things. For mortgage holders generally, roughly about 30% of their salary covers a mortgage, and yet other things get spent on lifestyle, goals, financial health, all those types of things. So an advisor is in a very fortunate position, really, that they have lots of different types of insurance that not only pay out on death, but also can be living protection policies. Some things, as you mentioned, so income protection is a great policy that pays out if that client can't do their occupation. And it doesn't need to just cover the mortgage. It can cover their living expenditure, their future goals, ambitions, savings plans. And we do need to, I guess, have those awkward conversations with clients whereby we do need to paint the picture of what would happen if something was to go wrong. We all know life can throw a curveball, and therefore there's other products such as life insurance, critical illness policies, all of which can give that, I guess, that safety net to the client, and provided you offer a tailored combination, can help meet that individual client's needs. All of which we cover with the Scottish Widows. So those three products you mentioned, life insurance, income protection, and critical illness, are available to us. And therefore, the client and the advisor can come up with a tailored approach that meets their individual needs.
Thank you, Steve. Rob, before we get into the discussion about this, tell us a little bit about Trust Mortgage.
I've been doing mortgages for 18 years and decided to go independent a couple of years ago. Trust Mortgage is my branding of my firm, and we're just launching now. So currently it's myself, but it will be more advisors as we go forward into the future. So that's a bit of the background for myself. Where I look at protection is that I'm really keen on talking about it, which I think Phil did mention before, and also Steve. My approach is that there's never a one size fits all. It's always a case of there is a need for someone to have it, but it's how you approach that, how you talk to the client. So, for example, for me, I always look at things like what angle to approach a certain client. If they're a client that's got a manual job, I'm really kind of thinking in the back of my head, this person needs income protection because I've got a manual job. The third thing that may happen is a short-term accident or sickness. If I'm looking at clients who maybe have 2 children, I'm massively thinking about children's protection, children's critical illness on the back of what I provide for the client. So for me, it is about where you approach it. It's about different types of approach and going back and forth with the client. So it might be that at that point you're speaking to them about the mortgage, they really don't want to talk about the protection at that point. So you may well find that you speak to them in a week's time once they've had the valuation done, or in a month's time once they've had their offer. But the approach that I will do is always speak about it, always make the client aware of what they can have, always go back to them, always provide different types of costings, cover, and one of the really important parts that I do is try to link the payment for cover, which is always the difficult part to get someone to agree to an everyday bill, like a Sky bill, like Just Eat payments, like coffee shop payments, pet insurance, to make it relevant to that person as to, well, I pay £60 for Sky, so therefore I should be paying similar amount to protect my earnings, my health, my life, my lifestyle, and my bubble, as I call it. So, and that's where I try and do different approaches with these clients, and I will be training my new brokers in the future to do exactly the same format because it works well. And you are fact finding, like people have said before. You are obtaining that information from them that you don't have to use it to provide them with the costings of protection.
Can I say something there that I think is some good points there that Rob brought up? I think we're really looking at for advisors to be advising clients, not just being brokers and broking one deal. I think getting the client used to the advisor going round to their house or their offices or wherever and reviewing the needs or updating the data that we hold about them. I think it's started to become really, really important. And I think if we just being tick box advisors and just saying, yeah, we've quoted somebody for a protection debt, I think those days are gone. And I think we're probably going to see advisors getting caught out more and more in the future if they just go along that sort of avenue. So we're really looking for advisors to take on board the fact that probably not all clients are going to be able to afford everything they need in one go. So setting up and teeing up the next call, going back, being comfortable in that environment, that's where advisors will earn their corn going forward because, as I said, not everybody will be able to buy and afford everything they want in one go.
Thank you, Phil. Rob, you wanted to come back in there.
Yeah, just leading on from that, Phil, exactly a brilliant point that you've made. I use these positive wording phrases like a starter policy for someone who doesn't know what they're taking on and may well decide to review it in 2, 3, 4, 5 years' time. These positive things like something rather than nothing, saying to someone in terms of when they're taking the mortgage out, this is an illustration. I've never ever used the word quote. And I'll tell you why. The word quote will send someone to a money supermarket, a comparison site. So I always use the word personal illustration, your own costing, and that works very well for me. But I think that using these phrases to get someone to understand, well, it's a starter policy because they're not going to take a big policy because they might not be able to afford it when buying the house. Then in 2, 3, 4 years' time, when the wages go up and something else happens, we may though review that, update the information, and then provide them with a better, I normally say either comprehensive or I do use the term beefed up. So something that is a bit better than what they had before because they've already taken one thing out. They will take the next product out with you and the next and the next. They pretty much remain loyal as long as you remain in contact.
Thank you, Rob. Steve?
I can just come on the back of that. So again, I think it's really interesting points that the guys have made there because again, when you start to think of your typical client, such as a first-time buyers now are much older than they were 20 to 30 years ago. You know, the average first-time buyer now is about 33 years old. Therefore, they're taking debt into a longer period and into an older demographic. So therefore, us having these regular reviews whereby we need to make sure that they are adequately protected. And some of those vulnerabilities that may have established, but they can't afford as a first-time buyer, we revisit, we go back. And once their affordability increases, therefore, we turn those vulnerabilities into resistance or resilience. We give them plans and solutions. So it's not a one one cap fits all. It's about going back and ensuring that we highlight risks because, like I said, first-time buyers in this is a good demographic will be later, will get mortgage later in life and therefore exposed to more risks.
And Steve, as Scottish Widows, do you see good examples where advisors are doing this well and clients are being appropriately covered? And I suppose the flip side is, do you sometimes see where opportunities are being missed?
Yes, so we see both really. The good news is we are seeing more and more advisors now giving more holistic advice. That's encouraging because they don't necessarily just offer a life insurance policy. But sadly, as Phil mentioned at the start, we do sadly see instances where it is a little bit of a tick box exercise. They produce a quote and perceive that job is a job well done. And it's really hard when we have to deal with a client that may have presumed they had cover in place, but their financial advisor or their mortgage advisor didn't do it. They didn't offer an income protection policy or a critical illness policy, as an example. And in so they just set up a simple life insurance policy, which is good, but only pays out on death. And many of these benefits are living benefits. Many of these clients their lives could be dramatically changed if they had a policy that would pay out on loss of occupation or having a cancer, a heart attack or stroke. So we see both elements. Obviously, we'd like to see the ones where we can help that client, but sadly, we do see many more examples where there's clients being let down.
Thank you, Steve. Really important points. Rob?
Yeah, I wanted to lead on from that. Me and Steve have had a chat before about kind of angles and how to approach clients. And he had a brilliant analogy of going into a restaurant and how you order wine, which I'll let him go through that analogy rather than myself. But for me, I have a very specific approach, which is I try and do 3 separate illustrations of a client, first of all. And one's like a top tier cover, which will be a life cover for the mortgage, maybe even some family protection, a critical illness cover, more than likely for the mortgage, and a really for valuable income protection, which will be at least 2-year policy or even longer. That cover will be the highest cover that I can give that client. 9 times out of 10 will not take that. Then I do a lesser amount, which will probably be full life cover. It may be an element of critical illness, but not the full amount, and an element of income protection. Again, it's a good value policy, but not as expensive or as comprehensive as the top tier. Then I do a third cover, which I class as either the lower level or something rather than nothing, a budget protection policy, which will normally have the same elements of cover, life cover, maybe some critical illness and some income protection, but will be the lowest amount you could do for a client before they don't do it. Now, the reason why I do that is because there are opportunities being missed and so many clients don't take income protection. I'm really big on income protection and protecting that short-term income. And that's because the experiences I've had so many clients who've been injured at work, who've had illnesses and things that have happened where if they've had cover, it's been amazing and they've been able to survive. And if they've not had cover, they have to go back to work sooner or they are suffering financially with the bills and everything adding on top.
Really key points. Steve, you wanted to come in. And also, I think we want to hear this wine analogy as well.
I am a little bit of a foodie, Gemma. So I think I remember having the conversation with Rob and we talked about, taking our world and putting it into the restaurant scene. So if you went to a restaurant and they only offered you main courses and didn't offer you starters and desserts, you'd feel a little bit shortchanged. Why was that waitress or that host not explaining the full benefits? There may be unhealthy options, healthy options, but you as a consumer want to make that informed decision. And that's what we refer to when we look at financial advice. Our advice is to expose risks, help the client see that there's solutions in place, and then help them to make those decisions. On the wines scenario, me and Rob were talking just around costings. And often, if you're presented with a wine menu, you don't pick the cheapest one because you don't want to look cheap in front of your date. You'd normally pick the second or third most expensive. So don't automatically think that the client is always going to be picking the less expensive option. They will sometimes, especially if they see the need and they can recognize it as it being an important feature, they will pay more for it. So don't be frightened by cost because the client will sometimes surprise you and actually make things more affordable than you expect.
What a great analogy. I love that. And Phil, I'm guessing that's one you'll be adopting at Cornerstone to train your advisors. Phil, I do want to pick up with you on something that you have all touched on, including yourself, where you've talked about the dangers of failing to recommend appropriate cover to clients. Can you outline to us, what are the risks to mortgage advisors if they're overlooking this?
There's two main areas, really. There's personal failings where perhaps you feel you've let somebody down, and there's professional failings where it could lead to some sanctions within the industry, depending on what you have or have not done. I think it all starts, as we said earlier on, with being comfortable with spending time with your client and going through their circumstances and have they changed over the last year or 6 months since you've seen them. But for somebody who has got the tick box approach, it could well be the fact that they haven't wrote any cover when they really haven't explained to the client exactly what could happen if they didn't have that in place. And if the client complains, or the client's family, if something should happen, complains about that, then we'd have to have a look what's on file and what's been said in the case. There could be sanctions around what you can do and what you can't do in the future, or it could be monetary value if the regulator goes against what's on the file and makes a monetary deal with the regulator on it to put it right. So, it could be disastrous for yourself and the business going forward if you try to skip around certain things or miss certain parts out. And it's something that we all need to look at. Britain is becoming the litigation that's going on now around financial services is more now than it's ever been. So you've got to be really, really clear with your fact finding. If somebody does say no, they've got to say, have said no themselves, not you just saying no for them. I think that's important to understand that it could come back to yourself. While we have PI cover in place, if you were going outside of the rules and regulations, then perhaps PI cover wouldn't cover you anyway.
And Rob, I can see you want to come in, but one just follow up for Phil, and then I'll come to you, Rob. Phil, at the very top, you mentioned consumer duty, which was moving the dial a little bit on this topic. Talk to us briefly about what changes consumer duty has brought about when it comes to protection insurance.
For a good advisor, consumer duty was a gift. The government, through the regulator, saying that you've got to be offering these certain products like protection. General insurance is another one that gets missed over as well. But if you missed out on these things, then you could well be punished within the industry. And that's not something we want to go down that lines. And as I said, that could well be clients that are saying, advisors that are saying, I don't want to write it myself, but they don't recommend somebody else to do it. They don't ask somebody else to write those cases for them. So if you're either got to write it yourself or you've got to refer it. And Cornerstone can handle that for those advisors that don't want to do it. But you need to document that very severely in the fact finds. Otherwise, it could end up with problems.
Thank you, Phil. Rob, you wanted to come in.
Yeah, I just want to lead on from what Phil has said there. So I'm at the grand old age of 42. So I started mortgages when I was 24, 2007. And I didn't have many personal experiences with people claiming and things. And over the years, the experience from what I've had to deal with has really, it's really changed how I approach the protection. So I had a friend that passed away that I had to do the life insurance claim for that I'd done for the client. So that was a real change in how I approach protection as well, because a friend passing away and you having to deal with the claim. I remember he left 2 children and his missus said, I wish we would have had more cover to me because we'd just covered the mortgage. And I think maybe Steve brought this fact up before, family protection is important, and not just protecting what you've got, but additional protection is very important. I've also had a client that got injured at work, and he was severely injured. He'd been almost crushed, and he had income protection, but he was going through the process of claiming for it. He was really struggling. Now it paid out, but there was a long process in that paying out, but I was there to help him and guide him with the insurer. So I think, one, protection is important, but having a broker to do protection rather than go and do it yourself. If you go and do it yourself, you've got no safety net, no peace of mind, no additional support. The broker doing it or myself, a protection advisor doing it, you do get that additional support, which we want to support people if they do claim. We're not out to give someone a policy that you're not going to help them out on. So I think a lot of the time people maybe assume, they'll let the broker do your mortgage, but on protection, they might not let them do it as much. And I think it's just kind of getting people to understand the rational approach that you're getting someone to advise you on a mortgage that's the biggest commitment you've ever done. let them advise you on the protection as well, let them give you guidance and support on what you should have in place, what you can take, and what probably you end up taking.
Yeah, some really tangible examples.
One point for myself was that sometimes as an industry, we could be quite greedy. We can all go out and find with a client, get all the information off them and tell them they need something ridiculous like £500 a month worth of cover. And there's no way we know they can afford that. We've got to make sure that we're treating, they know what their shortfalls are, but we give them a plan of action which they seem happy with, which means you may go back and, like Rob said earlier on, perhaps top it up the second visit, or write the next policy. They know what's coming next. So all these things are making the family more robust as they get older. They've gone through the first time buyer scenario. They may have now be moving into the children. They may be moving jobs, different things. There's so many different things can happen, but we just got to be comfortable with giving them the facts, leaving them decide, and not being too greedy by walking away from certain circumstances when perhaps we feel, oh, that's a small policy, and I haven't bothered writing it. That's not the case. We've got to write them in order and in a way that the client and the family gets benefited.
And Phil, you mentioned a few moments ago about how sometimes advisors feel that they're not equipped to write certain policies. They may be working alone and it might be an overwhelming amount of work. They might not have the expertise and so on. Talk to us briefly about the support the Cornerstone Network gives to its advisors so that they are fully prepared to have these ongoing discussions with their clients.
All the Cornerstone advisors have access to Friday training sessions where they get their CPD. Some of those will be mortgage related, some of those will be protection related. But they all have access to business development managers with the protection companies, people like Steve from Scottish Widows in this instance, so they can pick up on the training that they feel they need as well. We highlight it sometimes on their 360-degree review that there's training needed, and then we can push them towards certain people in circumstances that are suitable to themselves. So there's various different ways that you can pick up on this, but regular training and updating your knowledge has got to become far more acceptable in the industry than it has been in the past. I think we're probably the only industry that I know that doesn't train hard enough really and keep updating knowledge. So there's different circumstances for everybody. But if somebody feels that they have a certain part of their business and they can't fit in the protection sales into their own circumstances, then they can refer it on to an industry expert that's within Cornerstone. So there is an answer there. So you can write it yourself or refer it. But what you can't do is ignore it.
Really key point. I'm conscious of time, so I've got one more question that I'd like to ask each of you in turn. And that is, if a mortgage advisor is listening to this and is wondering what they ought to do, either to start talking to clients about these protection policies or to up their game with this, what would your key next step be for an advisor listening? Steve, I start with you if I can.
So the first thing I would say is that they are part of Cornerstone Network. So Cornerstone offer a great amount of support. So they will tailor the support that the advisor needs depending on what the client or so the advisor thinks they need. But out with that, there's so many BDMs that are there to help and guide. So whether that's just talking sales skills or conversational skills to more technical knowledge around trusts, about claims, underwriting. So there's a plethora of support and services available to there. Just reach out and we'll be glad to help and share some of our experience and our knowledge with you, because we're all in this game to have one ultimate goal, and that's to help consumers and clients be protected. So, we're on the same agenda. Let's work together.
I think it's vital that advisors realize the part they have to play in clients' futures. It's not just about going out there and writing the mortgage and walking away. If they are missing things, then they are putting themselves at risk, putting the clients at risk. So I think they got to feel comfortable with what they're doing, and they got to enjoy it. They got to enjoy what they do. That's vitally important. But if they feel they haven't got the knowledge in certain areas, then share it with their engagement advisor or people like myself or Graham Lewis and the other parts of the team. Just get that knowledge into yourselves as quickly as possible, really, and then you can decide what your own company looks like from a point of view of whether you write it yourself or whether you refer it.
Just leading a bit on from what Phil just said, I actually really love doing the job and I enjoy and love protecting clients. It's a skill that you learn over the years. The knowledge you get from the insurers like Steve at Scottish Widow, speaking to them about their products or services, keeping up to date with the most relevant products and services is really key as well. Knowing your product, like mortgages, knowing where to put a client for a mortgage. You need to know where to put a client with an insurer and tailoring how you advise the client, tailoring your angle. My approach is it works, it is good, but there might be an advisor that isn't comfortable in doing what I do, and they may well find a different approach works for them. So trial and error, trying something, coming back to it. If a client's not ready to speak, then we'll come back in for a week. And there's probably a lot of people who probably think, oh, I'll speak to them about it in a week. It becomes a month, and before you know it, they're 2 years down the line. Going back to the client will benefit from you speaking to them again. And again, they'll never say they don't want to speak to you, although they may not take a policy out. So I always think keep on the ball with the clients and keep speaking and engaging with your client is probably the most important.
Great. Thank you all. Some really wise words to end on there. Well, thank you to my guests, to Rob Jackson, Steve Evans and Phil Emanuel. And thank you for listening to this Cornerstone Finance Group podcast.